So participation trophies is one thing, and I love thinking about it in those terms because that's exactly what it is, the ultimate participation trophy, right? But you and I were talking last night about the importance of the Genius Act stablecoins.
Yeah.
And I think that's something I'd love to pick your brains on because it's something that a lot of people kind of hear and there's been a lot of press over it, but it's not that simple for people to understand because unless you understand stablecoins, which a lot of people don't, you can't understand the importance of the Stablecoin Act. So let's talk about that within the confines first of the problem that it potentially solves for the people who've passed it. I want to come at it from that first because there's opportunities around it, but it does solve, or at least it's a path to solve a significant problem.
Yeah, I mean, what the stablecoin or the Genius Act does, right, is it actually legalizes the creation of tokenized securities that reference the value of the US dollar. It defines the terms under which they operate. They have to be collateralized by US Treasuries, so effectively riskless short-term assets. Many people think that that's the primary objective, right? That the objective is basically to create demand for treasuries. One of the points I'd emphasize is there's no shortage of demand for short-dated treasuries. Right? They are basically perfect collateral, even as the U.S. has been downgraded. You know, nobody realistically is repricing U.S. risk in terms of repayment of 3-month obligations in dollar terms. But what the Stablecoin Act actually does is it legitimizes access to the US dollar for those who need it for transaction purposes on the global stage. And so if you think about the dynamics of currency, right, you will often go to a foreign place, you will find people transacting in US dollars because their own currency is viewed as unstable, right? They are seeking that access so that they have a stable mechanism of exchange, and they're foregoing the ability to invest that and earn interest. And this is really what the stablecoin legislation locks in place. You have the ability to offer the security, but you can't pay interest on it. All right. Now, in many ways, this is actually a step backwards. And it's one of the things that I emphasize over and over again about the crypto, particularly the Bitcoin aspect of it, is that in many ways, they're just a step backwards. And, you know, I've shared with you some of my framing around this, but the most important thing is by removing the ability to pay interest and effectively turning it into a platform-based designation. So Coinbase, for example, could offer rewards to investors that hold a particular stablecoin, effectively rebating a portion of the interest that they are earning on it. And that becomes a very platform-specific component. It becomes very much like a pre-regulation queue type banking. Like maybe we'll offer you a toaster for opening up a checking account, or we'll offer you various rewards. But ultimately, you're not going to have free claim on the interest. It's really going to be a function of our competitive behavior relative to other issuers and other platforms. I personally think this is a mistake, right? I think that there's various ways of framing it and taking advantage of this, but in a way, it's actually privatizing the seniorage component, right? We're going to give extraordinary returns to platforms that offer stablecoins by allowing them to retain the significant amount of interest. It effectively turns into a 400 plus basis point asset management fee on risk-free assets. And as many people point out, like people are more than happy to forego that investment in exchange for the transaction mechanism. And that's really what stablecoins represent. You know, there are any number of mistakes that are created by this. One is, I would argue that it's relatively short term in its persistence, because the simple reality is this 400 basis point asset management fees are ultimately going to go the way of the dodo. Whether that is because of competition among platforms like Coinbase, Robinhood, and others who offer these and will offer rebates. There's been retroactive moves to actually restrict that and declare anything like a reward is effectively a abrogation of this, and is going to be viewed as payment of interest. And so people will automatically seek out something else. And I think that there are ways to do that. I think ultimately the SEC will regain control of this process as we recognize that these are ultimately securities, which they're currently not designated as. And so a mechanism will emerge. I'm actually doing work on some of that. Have a couple of things in process that are trying to take advantage of this. And so I'm obviously biased to my interpretation of it. But the simple reality is that these are securities, right? And the failure to designate it and the failure to recognize that and avoid the SEC regulation, et cetera, will ultimately come back and bite them in the same way that money market funds emerged in the aftermath of the removal of Regulation Q, which allowed payment of interest on negotiable order of withdrawal accounts,
Now
unlike
who's
all
them? When you
checking
say we'll
accounts.
come back and bite them,
I think
let's
it's
be
going to come
clear
back and
about
bite the banking system.
right.
Right. I mean, what this really is effectively an attempt by platforms to reassert control, almost the exact opposite of the debanking phenomenon.
Yeah.
Right. You now need to hold your stablecoin at an established platform or at a bank in order to receive anything resembling rewards. You know, yes, you could hold it on an individual basis, right, in a variant of private custody, but
Why
it
would you,
doesn't.
right?
Why would you?
Yeah, exactly.
Right, and so there's a cost associated with that. Now, as I said, I think that there's ultimately mechanisms that are going to emerge that take advantage of the innate capabilities within smart contracts, and that to me is where the exciting part ultimately comes. And so I've been very, very consistent in trying to explain this to people, that there's a key difference between digital assets, tokenization, and what we currently have in the form of securities. And part of that is a recognition that the securities themselves are actually cryptographic tokens,
Mm-hmm.
right? So if you get a stock certificate, you'll notice that there's a particular number and there's watermarks on it, et cetera. Those are all historical cryptographic techniques to basically validate that this is an authentic document.
Yep.
This is an authentic entity. Um, but because of the paucity of the concentration or the ability to compress data in written form on a paper sheet of paper, right, or on a piece of paper,
Yep.
it's ultimately analog in its construction. It requires us to have the operating documents to that security totally separate, an S1 prospectus, 10K filings,
Yep.
14F proxy statements, et cetera, right? These are all distinct and separate from it. The governing documents of a mutual fund that's managed under the 40 Act are completely separate and distinct from the actual purchase of the security or the ETF security that's sitting at your brokerage account. I think that's going to change. I think all of that's going to change. And actually, the unique feature of tokenization is its ability to embed the operating documents. What is this security supposed to do? What are the rules under which it's governed? What are the manager's limitations in terms of how they're allowed to behave? What are the holders' responsibilities? What are the holders' obligations in order to preserve good standing on this stuff? Things like KYC, AML type frameworks. Those can ultimately be embedded inside the contract itself. And that's an incredibly exciting world because
Hugely.
all of a sudden you've actually taken something that is far more important than the actual transaction costs and the immediacy of settlement. And you've actually created the opportunity to build truly structured securities, right? Suddenly I can separate the cash flows from a corporation in terms of itself a distinct asset in which we call a stock certificate, right? It's a claim on the residual earnings of a company.
Yeah.
In which the ability to access that cash flow is determined by management policy. Do they buy back stock? Do they pay dividends? Do they direct it internally? Theoretically, there's nothing within tokenization that says, hey, I'm going to take a 1% discount to the payout rate in exchange for the management company, the management team no longer having control over what happens to my allocated portion of the profits, right? My earnings per share. I want all of those paid out.
Yeah.
Right? Theoretically, for a slightly lower return on capital, I could gain control over that type of feature, right? That opens up opportunities to manage cash flows as compared to manage derivations of cash flows and attempted projections of cash flows. It actually really changes the process of security analysis in a very, very meaningful way. And I think that world is out there waiting to be born. And as you know, you and I often discuss, the old world is dying. I actually gave a speech at the Solana conference, one of the keynote addresses, in which I highlighted that for all the magnetism and excitement around the ETF world, what you're actually seeing is the death throes, right? This is like the last combinatorial framework in which we can engage in these analog securities in which they are protected from taxation effectively within a Coasian framework of the firm, in which you are effectively saying, well, we can conduct in-kind transactions that are protected from taxing authority, right? It's an evolution of mutual funds. It's immediately exchangeable and settled on the exchange. It has very, very different characteristics than what we've seen before. But at the end of the day, it's those analog pieces of paper that are still being compiled and traded.
Right.
And tokenization and digitally native securities can actually meaningfully change that.
But let's talk about how this changes the incentives and what George Costanza would call the hand, right? Because again, it seems to me that the incentives shift, but also it potentially puts a lot more power in the hands of shareholders. You know, they can call a lot more shots, particularly given the concentration now we've got with the BlackRocks and the Vanguards, you know, all that voting power that they acquire. For companies, that could be a double-edged sword.
I absolutely agree with that, but that's part of the point. Is that
No, absolutely.
what we have largely done is abrogate agency, right? So we
Exactly.
use the term passive. Why are we passive? Because we actually don't play any role in the selection of securities. Well, why don't we play any role in the selection of securities? In part because we honestly recognize we have no voice,
Right.
right? The only opportunity to obtain voice is perversely when management teams have screwed things up so badly that
Right.
we can actually obtain proxy support to change behaviors.
Yeah.
Imagine instead compliance turns into a permission-based system as compared to an enforcement action,
Yeah.
right? They did
It
something
completely upends
wrong.
everything. Yeah.
We're going to, now we have to go after them. We have to provide the evidence that they did this with intent, etc. A permission-based system simply says, did I previously grant the permission to do this with my money? Right? And by the way, I can change that on the fly because this is a digital architecture, right? Click a button. Did my IP address that is linked to me or my zero knowledge proof identity say yes or no to this proposal, right? Would this fund manager be allowed to diverge from its stated prospectus in order to buy a unique opportunity? Well, conducting a shareholder vote in a digital framework is fantastically inexpensive.
Yep.
Right? And by the way, at some point to integrate AI into this, we'll ultimately all have individual agents that are effectively our individual fiduciaries that are able to take the complex language and the embedded programming in a digital security and say, well, what does this actually do?
Yeah, exactly right. Yeah, exactly right. But again, that changes the incentive structures
Radically.
dramatically.
Yeah.
And for corporate America, which has had it so good for so long, look, I'm all for getting the power back in the hands of shareholders. I think this is a terrific thing. I just wonder how hard, we were talking about raging against the dying of the light. I mean, we're going to see that in spades, I'm sure.
I think we are, and I think we're actually seeing it in process, right? I mean, part of the narrative that exists right now is you shouldn't be active.
Right, exactly.
You shouldn't be involved in this process, right? The system works magically, right? Your participation alone by handing your capital over to these 500 mega cap companies is going to guarantee your success and wealth, right? It's when the scales fall from the eyes of the true believers, right? When the Bogleheads suddenly say, hey, well, that didn't work out, right? That we can suddenly actually reinvent these systems. And now I'm, of course, cribbing from, I forget who it was within the Obama administration, never let a good crisis go to waste, right? That ultimately is largely what my, discourse is about at this point. It's like, look, guys, wake up to the possibility of what comes after. Right. And increasingly, I'm advising people, this, I've played a therapist role to any number of short sellers and value managers over the last couple of years, basically saying, some variant of the scene from Good Will Hunting in which Robin, Williams embraces Matt Damon and says, son, it's not your fault.
Not your fault.
Right? And he says, I know. And he's like, no,
it's not your fault.
It's not your fault. Right. And he breaks down and he's crying, etc. Right. There's a component of that exists in our world today. It's not that active managers are trying to be bad. They're actually trying to do what they were taught to do. They're trying to evaluate securities, but in a framework in which ultimately a non-thinking systematic algorithm that simply says, I buy everything that exists in proportion to whatever its last price times shares outstanding was. Ironically, that's taking the advice of John Bogle, right? Ignore price.
Yeah.
And it's elevating it to the single most important thing because shares outstanding don't change very often. Price changes all the time.
Unless you're AMC.
Unless you're AMC,
every day. Yeah.
But that is actually, that is one of the pushbacks, right? Theoretically, if there's a very, very low cost of capital, these companies should be issuing shares to increase the supply of shares that are available. But that's contra the interests of the management teams who are compensating themselves with share price appreciation, effectively warrants and options that are levered exposures to the price appreciation. If they can redirect the corporate cash flows towards participating in a system in which their buybacks actually elevate the price of their shares, why wouldn't they do that?
Yeah, right. Incentives, once again. But this idea of never letting a crisis go to waste, do we need that crisis now?
I believe
Have we reached that point?
Yeah.
It feels like we do.
Yeah.
But again, no one's invested in the crisis happening, except the people looking at it and saying, you know what, the best thing to happen would be a crisis.
Yeah.
But the managers don't want it, the investors don't want it. They're all going to continue to try and stave it off as long as possible. What is it that ultimately makes that crisis inevitable rather than advisable?
Well, the first is, going back to the observations that people make over and over again, combination of it's never different this time. The market can remain irrational far longer than you can remain insolvent, but it ultimately, puts itself into a framework where it does resolve itself, right? One of the points that I try to emphasize for people is any form of systematic strategy that takes withdrawals as a function of wealth levels and has contributions as a function of income
Yeah.
levels, has its own inherent resolution as wealth levels rise to the
Yep.
point that those contractual withdrawal levels exceed the income component. This is historically why something like the Buffett indicator, a relationship between stock market wealth to GDP, ultimately works as a limiting factor, for the very simple reason that that's literally taking those two components. It's wealth divided by
Yep.
income.
Yeah.
And so what if you properly understand that passive is not a magical process, that it's not a, improved theoretical framework that's suddenly leading to better outcomes for everybody, it's simply a forcing, right? It's the equivalent of water on your stove in a pot that you continue to apply heat to. It gets hotter and hotter and hotter until it inevitably boils, which is the water's way of releasing that heat. If you put it into a pressure cooker and you prevent the release of that steam, right, it eventually will blow up. Right. And so those are the choices we have. We can either allow the steam to release, which we've become increasingly uncomfortable with,
Yep.
or we can continue the process of forcing it and controlling that steam release. And that ultimately leads to a crisis. And it feels to me that we've gone past the point that we'll be able to gracefully exit this.
But this, it's funny that this idea of going past the graceful exit stage, you can look in any number of directions around financial markets, central bank positioning, interest rates, currency swaps. There's all kinds of places that it feels we might be past that point, and yet none of them has blown yet. And you talk there about this idea that this could be some kind of magic system. Everybody seems to have bought into the idea that it is a magic system and that none of these pressure points actually matter because none of them have mattered.
Yep.
Does that increase the risk that they all go poof at the same time? Because one goes, they all go?
Well, this is, ultimately this is the Minsky framework,
Yeah,
right? Stability begets
Exactly.
instability. And that is exactly what we're seeing. Again, it goes back to the point of where we are in this baseball game, right? When we talked 5 years ago, my argument would have been, candidly, I don't really know, but we're somewhere in the neighborhood of X percent and somewhere around 60% or so. Beyond 50, it becomes unknowable.
Yeah.
Beyond 65% passive, it basically becomes inevitable.
Yeah.
Right. We're currently, by most estimates, and this is one of these fantastical changes that occurred when I spoke in 2020 and I floated the idea that we were approaching 40% passive. Most people looked at it and they're like, you're insane.
Yeah.
Right now, of course, the academic literature has actually demonstrated this. Most recently, Bloomberg, among others, is confirming roughly what I think is right, which is we're somewhere between 50 and 55% passive. So we're past the point that I can tell you, like, here's what the model says, right? Because it actually kind of disappears into a stochastic ether that says it depends, right? It depends on what happens next. Do we remove the loading factor? I'll give a really simple example of that. Obviously, rising unemployment is one that people seize on, but well-intended legislation like let's increase the private share, the share of private assets in 401k legislation, depending on how that's funded. Is it funded out of withdrawals from treasuries or is it funded out of withdrawals from equities, which it ultimately should be, right? At the end of the day, these are levered equity exposures. Comparing them to fixed income exposures is completely insane, not beyond the capabilities of our current system, which somewhat defines insanity. But the simple reality is that would be a substantive shift out of public markets that would necessitate a sale, right, by passive vehicles. It's almost identical in its construction to events we've talked about before, August 24th, 2015, which was a rebalancing of Vanguard target date funds mislabeled as the Chinese revaluation of their currency. That Chinese revaluation of currency occurred actually on August 12th. As I like to joke, did the news come over on a slow boat from China or something? Like we all knew about it. It was a 2% devaluation. Yes, it was substantive in terms of a policy decision, but it had almost no impact on the markets whatsoever. And then all of a sudden on August 24th, 2015, we walk into markets and ETFs can't trade. Johnson & Johnson is priced at a penny, et cetera, down from, I think it was $70 or something. And everyone's kind of like, what in the world is going on? Well, it turns out if you read disclosures from Vanguard to institutional investors, that was the date that they chose to rebalance their target date funds. They used to rebalance them on a 5-year window. They, subsequent to that event, changed their strategy, so they didn't require rebalancing in the same size. They still do rebalancing, but that has increasingly moved to a continuous process. Which in many ways is actually a vol dampening strategy, right? If I'm continuously rebalancing, that's a vol dampening strategy. I think it's contributed to some of the anomalous volatility that we see in markets today. But that is out there, and there is still a big generational component to it that rebalancing has to be recognized as we move older and older in the passive framework. So older and older individuals are in target date funds. there's an accelerated sell down of equity exposure that is inevitable to that process. That could be a catalyst, right? An increase in unemployment, a change in policy. We recently saw Sherwin-Williams, for example, suspending its employee matching of its contributions. That is a reduction in flow that would be tied to corporate profitability. Same thing if we see significant deterioration as more people are growing concerned about in the profitability of the Mag 7, if ultimately it turns out that they have inadequately budgeted for their capital spending and the depreciation associated with that, and more importantly, the reinvestment that would be required, right? Because if these are only 3-year lived assets in terms of the underlying NVIDIA chips, et cetera, you're talking about massive amounts of capital investment that need to occur on an ongoing basis. You're seeing in companies like Meta and others how that is significantly deteriorating the strength in their balance sheet. They've drawn down their cash balances. They are now net debt. Many of the leading Mag 7 and technology companies are seeing a similar degradation of their balance sheet, whether it is in off-balance sheet form or capitalized operating leases, et cetera. Their obligations are growing, right? And so that means that there's less available to conduct stock buybacks. It means that there is less flow available to go into the stock market. And it accelerates that point at which the eventual sale emerges, and we discover that there's no bid underneath.
Well, this is interesting because, as we said at the beginning of this, you have been incredibly consistent with your message, right? And we talked. I remember we talked, as you say, 5 years ago. It's unbelievable. It was 5 years ago when you talked with Fleck and I about this first time on the endgame. So your messaging has been consistent. The trajectory of this has pretty much, to your point, followed your messaging exactly.
Yeah.
How have you found the response to your messaging has changed, if at all? Have you had constant pushback, but you've started to see less? Have you had constant pushback and now you're getting massive buy-in? Is the shift very subtle? How has that gone?
It's interesting, right? Because I spent so much time fighting on this that it's very hard to take a step back and say, hey, wait a second, I think I actually won this fight.
Right.
And it's incredibly arrogant to say that. I also want to acknowledge that, right? And so that's not part of the message. It's like, oh yeah, you guys are all wrong, I'm right. One, I continue to emphasize this is a hypothesis. Unfortunately, it's the only hypothesis that really fits the totality of the data, right? You remember the arguments that it was low interest rates that were enabling high valuations, right? Well, now we got much higher interest rates and we still have higher valuations. We've actually hit an all-time high in terms of things like the Shiller PE ratio, et cetera. And by the way, that's suppressed by the extraordinary gains in profitability. So the Shiller PE assumes effectively that those are not necessarily mean reverting in its construction. We now have a period of elevated profitability, which lowers the Shiller PE, certainly relative to the relatively low levels of corporate margins that we had in 2000.
Right.
On a price to sales or a sales yield basis, effectively embedding forward margin expectations were so far off the charts, it's not even funny. Those failed to conform to the interest rate narrative. And when interest rates were rising and you saw a mechanical rebalancing of systematic portfolios, and I think this is a really important concept for people to understand, as interest rates began to rise in 21 and in 22, as that accelerated and we moved faster and faster towards a high level, we actually saw something called the portfolio rebalance channel that has been highlighted by Jonathan Parker first at MIT and Zhu Lu, who's now formerly at Stanford, now at the University of Washington. What they highlight is that there's a mechanical property in something like a target date fund that is a systematically rebalanced fund. So if you just think about 50-50, make my life simple, 50-50 bonds, equities. The Federal Reserve hikes interest rates. What happens to bond prices? They fall, right? What happens to my portfolio allocation? Now I'm overweight equities, underweight bonds, so I have to sell equities, buy bonds, right? That causes equities to fall, bonds to rise. And that literally was the pattern that we saw throughout 2022, is this effectively relationship between bonds and equities that looks like a decreasing amplitude, sort of bouncing ball type framework, right? The minute the hiking process was over, and more importantly, as you reduce the duration sensitivity of the bond market, because now suddenly you were starting from higher interest rates, that ended. And we went right back to what we were doing before, right? The leading stocks were the largest stocks, the growth-oriented stocks, momentum-oriented stocks. Why? Because the marginal investment process became even more focused on exactly cap-weighted indices, which are momentum and size biased.
So as I say, you got pushback on this when you first put this theory forward.
You get pushback from multiple sources, right?
Yeah,
so
of course.
Initially, it's it's crazy, right? This is just, this is an active manager explaining why they're underperforming, right? World's smallest violin is playing. Then it becomes pushback from the value crowd, right? Or those, who are arguing for a reversion to the mean type framework. These factors don't go on forever.
We do matter.
Yeah, exactly. We're the smart people. They're the dumb
Right.
people. We'll be vindicated, right? And when you try explaining, like, no, I don't think this is going to happen because this is actually the dominant flow at this point, they get very angry.
Of course.
Right? Because they're effectively thinking that you're criticizing, their philosophy of life and the way that they approach things.
It's the anti-Upton Sinclair, right?
Yeah.
Right.
It's, well, I mean, I guess it's the embrace of H.L. Mencken, right? Which is what I think is actually the source of the quote that says, a man's...
I thought it was Upton Sinclair.
I'm not sure who it is. I've heard conflicting stories on
but
this.
we're both talking about the same quote.
We know, we're thinking of the exact same quote, which is, it's very difficult to convince a man of something if his paycheck depends on the alternative. And I think we're now at the point where at least those narratives are being embraced. Even individuals like Cliff Asness, for example, who I've had very public disagreements with,
you have,
will acknowledge that at least passive is playing a role, right? And interestingly enough, I would actually emphasize that part of my thinking, I referred to this earlier, as I was talking about the relative growth of noise traders or speculative traders versus the active manager community, shines a somewhat favorable light on his interpretation that, social media is rotting the brains of kids today, right? I don't think it's the social media per se. I do think that's a little bit of an enabling technology, allowing speculative traders to behave more like institutions in terms of the size that they bring in aggregate. But, to me, the enabling technology is the reduced elasticity that basically puts any type of transaction into a heightened response mode, right? If you buy zero data expiry options and you do so aggressively enough, you will force hedging by market makers. Those market makers will force prices higher, forcing more hedge, et cetera, right? The gamma squeeze type framework.
So have you reached, I remember I moved down to Australia in late 2005. And I remember talking to all my mates down there in Australia about this thing, subprime, that it was kind of on my radar. And I said, this feels like it might be important or something. And it didn't matter. It didn't matter. No one was like, mate, this is Australia. She'll be right. Don't worry about it, mate. It's all fine. We don't care about that. And then, as the global financial crisis unfolded, one by one, these guys would come over to my desk and crouch down next to me and go, mate, have you got time for a beer lunchtime?
Yeah.
You go for it. So tell me about it. Have you reached that point yet? Where, from the people that were pushing back, have you reached the point where they're saying to you, Mike, let's just have lunch and I just want to talk about...
It depends, right? So, I mean, there are some people who at this point, like the relationship became vitriolic enough that I've just suspended any attempt to contact. There are other people, though, who are increasingly doing that. And actually where I would argue that's happening most is suddenly I'm moving from the podcast realm, right? Where alternative media was basically seeking this out and saying, wow, this is really interesting. We've got to produce X quantities of long form interviews, and boy, Mike Green can really talk for a long time, right? And increasingly it's the CNNs and the CNBCs and the Bloombergs, et cetera, that are starting to reach out and engage in this stuff. There's more of a recognition that there's something that can't be explained by the normal theories of just irrational exuberance, which again, as you know, I actually think was actually passive 1.0. So it is starting, and that common knowledge is growing. And like I told you, I was walking down the street in New York the other day and somebody was like, passive investing, right? And
you're the passive guy.
The passive guy, right? Not exactly speaking to my, sexiness and desirability, right? Some people are the world's most interesting.
You're basically Jared. You're Jared from Subway.
I'm Jared from Subway. I'm passive man. Let's leave the pederast components out of it. But yes, that is definitely happening. And so one of the things that I think you're obviously aware of, I've been desperately trying to write a book.
I was just going to come on to that. I wasn't sure if you could talk about it or going to talk about it.
No, I can definitely talk about it because it's always great to talk about abstract things, right? But, no, I actually submitted a first draft of the 250-page target book to my publisher this past June. It was 650 pages in length, and I honestly sat there just struggling. Like, one is I fed it into ChatGPT and asked to provide the most brutal, critique possible, right? Wonderful use of ChatGPT as an author, by the way. And it came back and it's like, this is a polemic screed by a passive manager who seems to harbor, massive ill will for John Bogle, right? And I'm like, all right, that's not the message that I'm trying to convey. I literally was in Hawaii, as I have had some unique opportunities to get involved with the U.S. military. I'm laying in bed and I'm jet lagged and exhausted, and all of a sudden it like hit me that, wait a second, what I'm actually trying to do is write 2 books.
Yeah.
And so I was able to actually separate the two, write the intro to the second book, the conclusion to the first book, reorganize the table of contents to make sure that I'm actually coherent across
Yeah.
them. And so we're moving pretty fast now. I expect to have a final draft to my publisher in October, hopefully published early next year.
Awesome. Now, so let me ask you that process. Did you decide to write a book, or did someone come to you and say, "Hey, you're the passive guy. Have you thought about writing a book?"
It's a mixture of the two, and I mean,
Okay.
this is part of like the challenge, right? I mean, it's an inherently self-aggrandizing move, right? My thoughts are so important; they should be put down on the
Well,
printed
that's why
word for an
I asked the
extended period of
question,
time,
because
right?
their ideas have their time, right? And you will find people say, I keep hearing about this, and I hear you're the guy.
Yeah,
Someone needs to write the book, and frankly, however it comes about, you are the guy who should write this book. So I'm glad you're doing it.
yeah. I mean, look, I never thought of myself as a writer. I actually think of myself as having middling talent as it relates to writing. But through Substack and your promotion and everything else, like more and more people are paying attention to what
Yeah.
I write, and um I agree, like there is an element of responsibility, if not me then who, right?
Yeah. Exactly.
And so I do feel that it's necessary. Whether anybody pays attention to it or not, that's going to be up to them.
Well, I mean, I think they will, because they have to, and I think to this point, the timing could be perfect with this whole common knowledge component, right? Because if people are standing there surrounded by smoke and ruins that they don't
Yeah.
understand, and suddenly, ta-da!
Well, this is one of the points that I emphasize to people, right? I mean, Nassim Taleb wrote the Black Swan, or I can't remember if it was the Black Swan or the follow-on book, right? 4 months basically before
Yeah,
the peak in
yeah,
2007, right? Had he written it 5 years before, it would have been viewed as a screed against the dot-com
hmm
excesses and been forgotten by the time we got to 2007. As it was viewed as diagnostic,
yeah,
right? Oh, how could we be so stupid to assume normal distributions of complex systems? We know the systems are inherently non-normal. Why are we selling tails down here, right?
yeah.
And he provided a framework for thinking about that, right? Uh, I would argue mine is similar, and that like there's no blinding insight, right? I mean, this simple reality is that I owe a lot of a debt of gratitude to any number of people, including Bill Sharp for framing it incorrectly, Lasse Peterson for identifying the assumptions behind it. And Lasse Peterson, wrote a paper called "Sharpening the Arithmetic of Active Management" in 2016. That paper is actually incredibly critical to understanding how the hedge fund industry has transitioned over time. By far, the largest businesses at the multi-strats is one form of index arbitrage or another,
Right.
whether it's rate index arbitrage, bond index arbitrage that's occurring at entities like Exodus Point and Point 72, or whether it is equity arbitrage that's occurring at firms like Millennium and Citadel. That is the source of profitability at this point. And by the way, it's so robust that it underpins probably the single most valuable source of information that exists today. It's not research from Goldman Sachs or any place else. It's the flow
Flow. Yeah,
data
yeah,
that's
yeah,
obtainable through payment for order flow to Robinhood, right?
yeah.
So, I mean, like that is what has underpinned Robinhood's free commission model. And it was a recognition in, clear reference to Ken Griffin's genius that getting that noise trader data was irreplaceable, right? Just totally, totally irreplaceable. And so he literally knows what people are doing. He's able to see clarity around stuff that the rest of us can't. And we're all kind of sitting there surprised, going like, God, it's amazing how he continues to perform, right?
Right.
That sort of information arbitrage, particularly when it's enforced by legal status, like it's just inside information of another form. And I'm not accusing Ken of, engaging in illegal activity. It's fully blessed,
Yep.
etc. But it is an exploitation that I think people haven't fully appreciated for what it is.
Well, it's interesting. I hear you say there's no great insight here, and then I think about the old quote about there's nothing as powerful as an idea as time has come, right? And and whilst to you there is no great insight here, because this is the water you've swum in for so long now, it's remarkable to me when I have these conversations with people around this subject, from you know the foothills looking up you at the Mount Everest of passive. It's incredible how much insight even I can impart upon people who have heard the phrase passive investing and kind of know it's a thing, but don't in any way, shape, or form understand it. And many of them are kind of in the financial world. They're not complete neophytes to this thing, right? So this idea that there's no real insight, I think you're going to be astounded as to the kind of people who go, I didn't understand this stuff at all. Like, this is incredible because it's so big and it's so important. And yet passive investing is a phrase that people write off and they go, oh yeah, there's a big passive bid.
Yeah.
No one stops to go, what does that actually mean?
Yeah.
Because they don't kind of need to. They just know it's a thing and it's something to be aware of. Once you dig into this stuff, it's so much more than that, right?
Well, yes, and candidly, again, like as you know, that is really the subject of the second book, right?
Right.
Which is what I was trying to extricate, right? So, one is diagnostic. The first book is called The Greatest Story Ever Sold. It's emphasizing, look, this is something that was sold to us. It was pitched to us. It's built on an assumption, on a model-based assumption, and those assumptions were simply wrong. Right. I mean, the simplest one is the inelasticity, which was brought to light by Gabay and Koijin in their 2020 paper, the inelastic market hypothesis. But, you know, the idea is very, very straightforward. Under the EMH, all information is what drives flows, right? So you form an opinion on future cash flows based on information that you have gathered. And then you make a weak declaration as to the direction that the stock price is going to move based on other people slowly becoming aware of that. Your individual transaction has almost no impact on the market at all. In fact, one of the components of Grossman-Stiglitz, which is the framing of why markets can't be perfectly efficient because obtaining information is costly, as anyone writing the check for payment for order flow for Robin can tell you, right? It presumes that information is fundamental in nature, or at least it frames it that way. But it's a general information theory. It's not, I get to figure out what the cash flows are. Those cash flows are ultimately an attempt to solve for a value equation, right? And as we know, markets are voting mechanisms, not necessarily weighing mechanisms. Passive just elevates the vote, right? And it turns it to a scale. Grossman-Stiglitz, as I was saying, relies on a concept called equal endowment, right? Everyone gets one vote. Now, that sounds an awful lot like democracy in action. That's not how capital markets work. But it is actually the theoretical framework that underpins the wisdom of the crowds, right? So Francis Galton's famous experiment with, you know, the ox at the county fair. Everyone gets a vote. Everyone gets to choose how high it is. There's an incentive. You win a prize if you do so. And so you're incentivized to try to make an educated or somewhat accurate guess. There will, of course, be participants who are in it just for the lols, right? And decide to say it's £1 million, right? And there'll be other people who say, you know, I don't see, you know, there's an existential discussion. I don't see an ox at all. What are you talking about? Right. So 0, right? But the reality is the majority of people have one vote, and that converges on the normal distribution, which gives you effectively a law of large numbers equating to something close to the right answer. The problem is that system completely breaks down when you remove the concept of equal endowment. If suddenly it turns into the number of votes is radically skewed by your distribution, in other words, Vanguard gets many more votes, or in the Francis Galton experiment, every villager gets 1 vote and then the mayor gets 10,000 votes. Well, what you end up with is what the mayor thinks it's worth, right? Or how much it weighs. Right. And that's going to be farther away from the right answer than if we actually relied on each individual. Well, now we're at a point where passive investors acting en masse, choosing a particular form of methodology, have 53% of the votes. Right. And so what we get is effectively an articulation that there is no value, there's only price.
Well, and you capture the market, to your point, right?
Right.
Which was always the end game. Ultimately, was the capture of the market.
Yeah, I don't think it was intentional. I think it was. I mean,
whether it was intentional or not, that was to your point. 5 years. This is where it's going, right? Everybody needs to understand where this is going, and if we're there or we're close to there, you know, when you described it to me, this is where it's going. It felt like once it gets there, functionally, that's the end, because when you get there, things start to happen that ultimately sow the seeds of its own demise.
Yeah, and I think you're starting to see some of those, right? I mean, the extraordinary price moves in companies like Oracle or others in recent weeks, the market's total disregard for the fundamental information that's emerging around the circularity of the profits of the Mag 7 as it relates to AI spend and the AI build-out. You know, all of us are slowly moving into a mode where, like, wait a second, this isn't accurately reflected. At minimum, this should result in a significant discount as we resolve this uncertainty, and the market seems totally unfazed by it, right? Well, that is because the market, certainly the marginal participant, is totally unfazed by it. There's
Hmm.
nobody who's paying attention to that. You simply are participating in the process of allocating capital, supplemented by corporations buying back their own shares, at least for the time being. That is becoming more and more and more apparent, and this is unfortunately directly what my models suggest. As you cross over to levels of passive that we're getting to, the market itself experiences periods of volatility that effectively cause people to suddenly say, wait a second, I can't
Yeah.
really participate in this. I have no idea what's going on, right? I mean, what's the Bitcoiners rally cry, right? Bitcoin will become less volatile over time, therefore it becomes investable.
Yeah.
Instead, what we're actually seeing is large cap equities are becoming more volatile and more unpredictable over time. That means on both sides of the equation, people who are trying to normalize valuations by shorting them, increasing the supply of shares by shorting them, right, which is what you're actually doing. You're synthetically making additional shares available to pressure the price lower. They're terrified. Nobody wants to be short because it feels like a completely asymmetric bet all of a sudden. That means that there are no forced buyers, natural buyers, when prices begin to
Yeah.
fall. In fact, the only remaining buyers under those conditions when prices begin to fall are the value investors who have been screaming since give or take 12 times on the S&P that it's overvalued,
Yeah.
right? So that's a long way down, and
I'd say that
unfortunately,
there's a big
again,
air pocket
yeah, there's a
between here
big
and there.
air
But
pocket
yeah.
there, right? And the more short interest that is eviscerated, the more long short strategies are eviscerated, the more behavior that we see is effectively, well, let me just see how I can exploit this inelasticity to drive prices to an extraordinary level in pursuit of my individual profit. The more you're ultimately making the market uninvestable.
But it's also interesting. It's interesting you use that Bitcoin example because you're absolutely right. It'll become more investable because it becomes less volatile. But once it becomes less volatile, it becomes less investable.
Yeah.
And it's going to be the same with equities, right? Because people have been used to getting their quarterly statements saying, "Well, I'm up. Look at this, I'm up. It's great. This is great. I'm up
Well,
5%, whatever it
so
is."
yeah, so I would argue actually that there is a difference, right? So I
Okay.
mean, one of the unique characteristics of Bitcoin is it ultimately has a fixed supply, and
Yep.
so you are not particularly worried about
Okay. Yep.
additional sources of supply emerging. What we're starting to see is those same platforms, the Robinhoods and Coinbases, et cetera, of the world, are becoming the new power brokers in IPOs, right? One of my long-standing assertions that has largely been validated is that IPOs would be very difficult to pull off without the support of passive investors. Well, what's emerged is a new generation of E-Trade
Hmm.
investors from 1999 who say, well, I seek and crave this, right? I
Yeah.
can buy the narrative, right? I bought the Bitcoin narrative, I'll buy anything. And as a result, you're seeing suddenly extraordinary interest in some of these IPOs that people are being told, here's the velvet rope, you get inside
Yeah.
because you're a
Yeah.
Coinbase customer, you're a Robinhood customer, etc. That's largely irresistible, right? Now, what it does is it increases the supply of securities. That suddenly starts to change the calculus as well, right? It's an increase in supply, whereas previously we had largely had withholding of supply and actual contraction of supply of shares on the secondary markets.
But it does align the way these two sets of investors think about the incentives, right?
100%.
And
Yeah.
that's potentially the issue because again, you're going to suck in at the worst possible moment the people who think, well, equities because a passive number go up,
Yeah.
right?
Well, and that's exactly the point that I'm making,
Yeah.
right? So I mean, people are starting to recognize this. They're like, well, it's just the structure of the market. The passive bid goes on forever,
Yeah.
right? And unfortunately, that's that is paying attention to half of the argument, right? I'd argue on the corporate side, I have more and more entities reaching out in a consigliere fashion and saying, hey, could you give us some advice about how we could attract more passive bid?
Right.
And it's
Interesting.
like, oh, that's an interesting
Yeah.
conversation. Companies are increasingly recognizing this. There are IR firms now that explicitly incorporate this into their ethos. And I can't, like, none of this is bad, right? I mean, like, this is behaviors that are created by the incentives. And so corporations increasingly recognize, like, it doesn't matter what I'm going out and saying to the active manager about, look, my business is misunderstood. You guys should really buy it, because the reality is they're increasingly recognizing that those active managers are on a shorter and shorter time horizon. Their ability to prove out their capabilities is getting shorter and shorter and shorter, and as a result, they're just weak holders.
Yeah. It's funny. I'm currently reading Peter Pomerantz's book. Nothing matters and everything is possible.
Yeah,
Right. And I just have this phrase rattling around my head now that we're in that phase where
yeah,
whether you're a corporate or an investor, nothing matters and everything's possible. But you just it ends badly, and
Yeah.
it really is. We're at that point where if guys like you who really understand this stuff are starting to say, look, it's time to be a bit cautious here, because the point in the far distance I saw 5 years ago, I can focus on it now.
Yeah.
No one's going to listen to you, right? We all know that, because the incentives are skewed. So, well, yeah, Mike could be right one day.
Well, this is why the institutional magazine article, institutional investor article on my stuff, it's like why Mike Green is the Cassandra.
Cassandra, yes, exactly
investing,
right.
Like
exactly
you have to be a Cassandra. At the end of the day, if you're prophesizing something, regardless of whether it's going to come true or not, if the incentive structure is aligned against people believing it, right? Like if I were telling people, look, this passive bid is fantastic, we're all going to become fantastically wealthy, and it's going to go on forever, right? Well, there would have been a resistance, but ultimately an embrace of it, as many people have that only listen to part of the story, right? And instead it's like, no, look, we are actually engaged in societally destructive activities. We really shouldn't let in that Trojan horse that the Greeks have offered us as a gift, right? That ultimately portrays doom, and people are like, it's a wooden horse. Like, what harm could it actually do, right?
And who doesn't want a wooden horse?
And who doesn't want a wooden horse, right?
We all want a wooden horse.
Yeah.
Man, I tell you what, it is the greatest story ever told in these markets, right?
Well, I emphasize it's the greatest story ever sold.
Yeah.
Right. And that's, to me, the sign of a really remarkable salesman is somebody like John Bogle, who actually literally convinced any number of people that he wasn't selling them, even as he was marketing like mad.
Yeah.
Right. Like, what a genius. Like, honestly, to get to play the, like happy old professor, et cetera,
Right.
and he's saying, things that are literally 180 degrees reversed, right? Like there's a clip of a interview that was never published, to my knowledge, with him and Cliff Asness, in which he's saying, ignore price. And this is my message. It's like, ignore price. It's like, well, wait a second. Your entire weighting schema is price times shares outstanding.
Yeah.
What you're actually doing is ignoring value. You're ignoring the cash flows. You're ignoring any component associated with anything that is not directly observable in financial markets, which is the entire point, right? The price is supposed to reflect a forecast of future cash flows discounted back to the present. And that's the part that you're actually ignoring, right? But he flipped it around and he told people, this is all a narrative that is being constructed by underperforming active managers who are stealing your money. Wow, what a compelling story.
Right. And how old was that interview?
That was 2018.
Right. So it doesn't matter, right? Because look how things worked out. And no one cares.
Right.
Because it worked out well. If it works out badly, people are going to pull that interview out and go, can you believe this guy said that?
Yeah, I don't think so, actually. I think this is one of the things that's important. And again, it's forced me to consider this. There are mythic figures, right? I actually believe that John Bogle, while he was marketing, simultaneously believed that what he was saying.
Okay.
Right. And that, to me, by the way, is one of the reasons, like, you hear me talk more about Vanguard than you hear me talk about BlackRock, right? BlackRock, I would argue, is a cynical exploiter. They're incredibly good at what they do, but they're not true believers, and they'd be perfectly happy to do something else if it meant that they could attract assets, as they showed by offering the Bitcoin ETF 2 years after declaring that Bitcoin was, a Ponzi scheme. Right. Vanguard is true believers, right? And, just like Christianity and the true belief of monotheism heralded the fall of many of the historical components in society, Western Rome, et cetera. It's those true believers who are really scary.
Yeah.
Right? Because they cannot be swayed, and they are going to do it until its logical completion.
Well, and when they're right for so long, that just makes it that much more powerful.
Of course, yeah.
Yeah. Mate, this has been fun, as always.
It's a real blast.
We have a dinner to go to.
I know, we're late.
We're all very late. Thank you. And listen, if I don't get an advance copy of that book, I'm going to be really pissed at you. I want to say that on camera because I want to read that. And good luck with it. And we will talk again when you get ready to publish it.
Awesome. Thank you very much, Grant.
Thanks, man.
Take care.